Good afternoon and welcome to the September 29th meeting of the Lextran Board of Directors Finance Committee. My name is Jill Barnett and I'm the General Manager here at Lextran. I will turn the meeting over to Mr. George Ward, the Chairman of our Finance Committee.
Thank you. Welcome Finance Committee members and staff members. And Brad, who is our outside accountant. Our first order of business is to approve the minutes of the April 6th, 2022 meeting, which is attached to our packets. Need a motion?
Motion to approve?
Second.
Second. Motion and a second. All in favor say aye. Aye. Anybody opposed? Motion passes. So our main order of business today is the audit presentation from both Crow and, well, I guess Nikki would probably contribute, right?
Yes.
So, Brad, you can take it away.
All right, well, thank you. My name is Brad Shelley. I'm a partner at Crow, and glad to be with you all. As you probably are aware, we rotated partners this past year. Scott Nickerson was the partner on the engagement for a long time. I've worked with Scott for a number of years on a number of different public transit agency audits, and glad to be with you all today. So I'll walk through the three documents that you all have and that's on the screen, starting out with the financial statements. And feel free to ask questions as we go through. I'm pretty informal about this. So if you have questions as I'm going through it, just stop and ask. I will say before we get too far into it, there were nothing too significant this year as far as new accounting standards or auditing standard changes. There are a few minor things that we'll go through. There was one new accounting standard that was more significant for a number of government agencies, but didn't really impact Lextran as much this year. So we'll talk through those as we go through. So pretty similar when you're looking year over year, and that's helpful when you're looking at the comparative financial statements piece of it in the MD&A to be able to understand if there's changes there that have impacted the transactions. So on the first couple of pages here, we have the independent auditor's report. This is one of the new changes. This is a new auditing standard change that changed the format of the financial statements or of the actual audit report. Doesn't really change substantively the result. We're still providing an opinion on the financial statements. We're still adhering to the same professional standards we did before. We have the same responsibilities, management has the same responsibilities, so it doesn't really change anything there. Primarily what it did is it moved the opinion up to the very first paragraph instead of burying it down in like the third paragraph, and then it outlines in a little bit more detail some of our responsibilities. So our opinion is provided here. We're providing an unmodified opinion, highest level of assurance we can provide, meaning these financial statements are free of any material misstatements. As I mentioned, the responsibilities of management are listed here. Our responsibilities are listed here. And again, this is longer than it was before, but there's nothing new in here. We already have these responsibilities. It's just required to outline more of those. It does have a couple of paragraphs on the required supplementary and the supplementary information. Again, no changes in any of those, or providing in relation to opinion on that information, meaning that in relation to the basic financial statements, those are materially stated as well. Then we get into the management's discussion and analysis, or the MD&A. This is unaudited information, so I start out with that just so that you're all aware, primarily because this is the part of the financial statements where there is some background on information on why balances change, why transactions occurred. Those can't always be audited, and there's obviously a piece in here about the economic outlook in the future. Those are statements, again, that can't be audited. So this is unaudited. That's the typical for any government financial statements. But I think it is still helpful in a number of ways, especially with you all presenting a single year presentation, which is what we see most government agencies do nowadays, especially as there's so many new accounting standards that are being implemented. Oftentimes those accounting standards require you to go back to the earliest year that's presented. So if you're presenting 2 years, that requires you to make modifications to 2 years worth of data. So single year presentation is the most common, but what the MD&A does that is helpful is it provides 2 years of information. So you can see those comparisons year over year. And so as we look here at the bottom of the page, this is providing your financial position or your balance sheet in a summary level year over year. And so you can see current assets increased about $4 million. That's primarily related to cash. And we'll get into that a little bit more on the following pages. The non-current assets also, you'll see here listed here as well. Not a lot of significant changes, the most significant being the net pension asset increased. That was primarily the result of some actuarial changes in there and increase in the discount rate. So that increased from 2.1 to 3.7. The main thing here is obviously it continues to be an asset versus a liability, which is where most pension plans are, generally speaking.
While we're on this page, just an explanation of the notes payable and how that will be treated next year.
Let's skip to this next page then, because that'll fall under the, unless you're talking about the notes receivable, but so the notes receivable, and this is probably easier explained in the back in the combining schedules, but essentially all of those transactions are going to roll up back into Lextran. So the foundation and the real properties, those transactions will all fold up or be paid off, in air quotes, I guess, be paid off, and it'll roll back into Lextran. I think the end result, and Nikki, you could correct me if I'm wrong, I think it was about a $3 or $4 million book loss that you'll have as a result of that. So it won't be a cash outflow of $3 or $4 million. It's simply a book transaction that'll take place. I think it's already taken place, but it'll be shown in the FY23 financial statements. So that it's not reflected in this year's financials, but it will be reflected next year. You will see that loss flow through next year, and you'll see those combining schedules. All of those will be zeroed out, I believe.
When will it start to show up? What month?
August, it was on this,
Okay.
this
Okay, so it's already-
sheet from yesterday. Because we did we wrote off the 8.3, and then we transferred over $12 million in assets to Lextran. And we did that in August.
And so we have not audited any of that. That's my understanding of how it's all going to work, and we've had some conversations about it, so I have a general feel for that, but we obviously haven't audited any of those transactions yet.
And the August financial statement did go to Shelby, so she has seen it.
Yep. The rest of the financial position, statement of financial positions listed here, your liabilities.
Hang on 1 second.
Sure.
Okay, go back to assets and
Yep.
cash restricted.
Yep.
So what specifically is that?
The restricted cash. I believe that is related to, I was trying to look through your financials here, but I believe that's related to the debt. Is that correct, Nikki? Do we have a footnote disclosure in that?
Because our cash reserves just count as part of the cash, right? It's not considered restricted.
Right.
Yeah, sorry, that is related to the debt. I was trying to find it in the footnote.
Okay.
So it's actually on page 37. That's under the Lextran Real Properties. That is loan proceeds that are restricted for future payments there. So again, that'll be part of the transaction to close out
So will it go
Lextran Real
away?
Properties and Foundation.
Yes, in July, we transferred all of the remaining cash from Lextran Foundation to Lextran.
Yeah.
So it'll all disappear in FY23.
It'll move over to Lextran, yeah. Not disappear. The
Right,
cash-
yeah.
The
I meant
cash will go.
disappear from Lextran
It'll
Foundation.
disappear from that entity. It will end up on Lextran.
And then it just shows up as unrestricted cash for
Mhm.
Lextran.
It shows up as other revenue on the statement of revenue.
Okay. Thank you.
Any other questions here? Okay, so moving on to the liabilities and net position. No significant changes on the liability side in current or non-current liabilities. Deferred inflows of resources is related to your pension plan, and so you see.
So the net position unrestricted, we have 35M.
Which one, I'm sorry?
Net position unrestricted.
Yes,
So we have
I think that's
35
right.
million available.
correct.
That's impressive.
35 million unrestricted.
Oh, yeah.
Yeah, and most of that increase.
I understand it's a picture on June 30th, but that's impressive.
Yeah, so.
Net and you all are impressive.
Get the money where we can.
You're
And
doing a good job.
Nikki keeps a tight grasp on it. She does well.
We had 24 million in cash and then 10 million, which at that time included the notes receivable for Lextran Foundation, so that was 10 and a half. So
Well,
that's where the
keep your
35.
finger on the price. You're doing a good job.
Yeah, that's really, the increase is a combination of, some of that is non-cash, so like the pension asset increased by $1.6 million. So that increases your net position there. Again, not a cash transaction. Some of it is cash related, some of it's operations.
Mhm.
Some of it is federal capital contributions that you're getting those in now. There's no expense associated with that because it comes on as a capital asset, and you'll have expense over time, depreciation expense. So it's really a combination of all three of those, which we'll see in the financials later.
Yeah, I was wondering on the total assets, where you say it increased in part due to the following. I mean, would we not list COVID money in there? Is that where most of it comes from?
Well, the COVID money doesn't increase your assets per se, because that's all
Increases
cost
your cash.
reimbursement related. So you're spending dollars and then you're getting reimbursed with the COVID money. So it doesn't have a direct impact there. Would you potentially be paying for those expenses with another funding source? That's where
Yeah.
indirectly there's an inflow there. But as you're looking at the overall, the change in cash, it's a variety of things, and that's shown kind of in the cash flow statement. But
But
yes.
COVID may play a big part of it because there are some avoided costs that
Certainly,
already
yeah.
Yeah,
Yeah,
so
we
instead
had-
of using our other revenue sources, we use that money.
Yes.
Yeah, we had 5 million in Carissa funds.
So I'm not the CPA, but when I look at our statements and I see that big difference, it's COVID money.
That's a large chunk of it, yes.
We also bought some buses too, so
Yeah.
that's some of it.
The rest of the MD&A goes through capital assets, which, as Nikki just pointed out, that's where you see most of the increase in capital assets is in buses that were purchased, about $2.2 million of motor coaches and vans there, some other minor increases and or additions as well. The notes payable, again, no transactions there during the current fiscal year. You'll see that will change next year. At the top of page 9 is a summary of your operations and changes in net position. This is looking again at essentially your income statement. So when you break this down or really summarize it, the operating revenues increased about $800,000. That's primarily your fair revenue, right? And a few other pieces of advertising and some other income. but primarily are fair revenue, so you're seeing increases there, and that coincides with the increases in ridership that was on the first page of the MD&A.
That operating expenses for 2021 should be bracketed, right?
Yes. I can remember that real quick. Yes, 24 million of expenses last year, 26 million this year. So you do see an increase in the expenses. That was a combination of factors, increase in some salary and wages costs, increase in fuel costs. So the end result was about $1.4 million increase. Depreciation fairly consistent, 3.2 in the prior year to 3 million. Then you get down to your non-operating revenue and expenses. This is where a lot of the other funding is coming in as far as your property taxes and your federal assistance that's non-capital. So this is operating. So this would be your COVID money and some other federal grants. There's some state grants as well. That all is about 27 million. And so when you look year over year, it actually was a decrease, and we'll talk more about that. But part of that is related to the preventative maintenance grant that was not able to be recorded as revenue this year. It'll be recorded next year. That gets you down to your gains.
So if that would have been in here, that we'd been up a little bit.
Yes.
It'd be $4 million.
Yeah.
All right, and one quick question.
Yep.
I know the answer, but just for clarification. On the operating revenues, that's fares and UK and maybe what else?
Advertising.
Advertising, I was gonna say that, okay.
Then the last piece of revenue is the capital contributions. These are your federal grants that are paying for the capital improvements, or in this case, the buses that you receive. So $2.2 million in the fiscal year that we're looking at, FY22. Overall, your change in net position or your net income is an increase of about $4.6 million compared to last year, about 7.1. So still positive in both years. The bottom of this page is really just breaking down that the sections above in a little bit more detail. So your revenues are here. We just talked about that. And then expenses are on the next page, and again, breaking that down into a little bit more detail so you can see the changes. The summary of the statement of cash flows is listed here on page 11. The full detailed schedules on page 14. This is just, again, breaking it down into three main categories of operating, non-capital financing, and then capital and related financing activities. So you can see the operating activities as a cash outflow of about $25 million. Common for that to be shown that way because all of the federal and state property taxes, all of those types of things are all considered non-operating. So they don't fall under this. The only thing that goes in here from a revenue standpoint or a cash inflow is fair revenue advertising, like we just said. So operating outflow of cash. The next line of non-capital financing is where you see all the property taxes and grant money coming in to offset that. And then capital obviously is related to any capital contributions or other dollars coming in or out from financing activities. Overall, a change in cash of about $8.3 million. Any
Blessed.
questions on this before we jump into the basic financial statements? Okay. So this gets us into the basic financial statements, the statement of net position. I won't go through this since we just talked about it in the MD&A section, but again, if you have any questions on any of these balances, happy to stop and walk through those. Same thing here, your statement of revenues, expenses, and changes in net position for fiscal year 22. We walk through this. And then your statement of cash flows. And again, this just gives more detail than what was provided on the previous page. Then on page 15 is your statement of fiduciary net position. So this is related to the pension plan assets. And so because it is a self-employee plan, you do have this on here as a fiduciary net position. So those assets that are underlying and going to pay for those future benefits, those are recorded here. So this is included in the Lextran financial statements, but it's not part of the numbers that we were just looking at back here, if that makes sense. It's a separate pot of funding.
That Gatsby 68 was the dumbest thing that ever come up. It just doesn't make any sense.
So, yes, between GASB 68 and then GASB 84, which required all of this to be consistent across organizations, be to bring in all of those assets and show it as a fiduciary activity, certainly complicates matters.
Mhm.
So you'll see here about $20 million in assets. There's no liabilities related to this. It is all restricted for pensions, though. And so on the next page, you'll see the changes in the fiduciary net position. This is really just your contributions, both the employer and the employee contributions, the investment earnings, and then any benefit payments that were made during the year. So overall, a net increase in the net position from 17.2 to 20.1 million. And again, that plays a role in what you saw as far as your pension asset. As these assets get higher, as long as that continues to outpace the liabilities, then that pension asset that's on the Lextran financials will continue to increase. From there, we get into the footnotes to the financial statements. And again, I won't go through each of these. Most of these are pretty consistent or similar to what you've seen in the past, and so I'll just point out a few things that maybe have varied a little bit or that are new. So as we go through note 1, this is just providing all the accounting policies. There weren't really any changes in any of the accounting policies, so there's nothing too significant to point out here. Again, these are all similar types of activities as you've had in the past. The only thing that I'll point out is here on page 21 is where we list out all the new accounting pronouncements that were adopted during the year, and point out that none of these had any financial statement impact. So there were no changes. GASB 87 related to leases is the one that, again, is the most common for governments to have a significant impact. In your all's situation, you didn't have significant or material leases to record. The impact that would have happened is you would have essentially put an asset and a liability on the books. They would have pretty much netted to zero and wouldn't have had much impact, but it would have grossed up your assets and liabilities. You do have some leases,
But had a big impact on my real job.
Oh,
On that one.
I bet it did. Mm-hmm.
Did you see an impact on my real job?
I said that impacted my real job a lot.
yes, depending on where you're at, that can have a significant impact. For you, it didn't have really much of an impact at all. Going through the rest of these, again, we talked about capital assets. No real changes here. We do still have a lease footnote just to disclose the leases that you do have, but as you can see, pretty minimal. The tire leases are specifically excluded from GASB 87 because they are there's a variable piece to that based on the wear of the tires. So those, while you do have tire leases, those don't fall under GASB 87, aren't required to record that way.
I asked this before, but that's the typical practice of transit agencies to lease tires.
Yes.
Yes.
And the reason?
One, due to storage and cost. Two would be constant changing of vehicles, and
We also don't have to pay for basically the disposal
Yeah,
when we lease
disposal.
them. The
That's the one I
company
was trying
takes
to
care
think of,
that. There's
disposal.
some
Mhm.
environmental costs associated with that.
How many miles do you get to a set of tires?
that I don't know.
We'll get back to you on that.
That one I don't know, but we will find out.
It definitely varies, and I don't know how your all's agreement is. Some of them are based off of the tire and tread. Some of them are,
Tread,
most
yeah.
of them I've seen are based off of the tire and tread.
Ours
Ours
is.
is the tread deck, yeah.
Yeah. So sometimes it varies quite a bit on the mileage depending on what buses.
What's typical mileage? on the bus?
Again, no changes to the notes payable in this current year, so those are still disclosed here. And potential future payouts are listed. The fiduciary fund we talked about, this is just providing the required disclosures around the investments that are held in the fiduciary fund, so nothing too wild here. U.S. government obligations, corporate bonds, stocks, and mutual funds, and the fair value levels for each of
Go
those.
back one page if you would.
Sure.
Just on the debt service. So I guess that's the way that we had it set up, the
This is,
12 million.
yeah, this is Lextran Real Properties and Lextran Foundation.
So does all this go away next year?
Yeah, it's gone. It ended
Gone
on
now.
July the 14th, 2022.
It's just weird that the
7
principal
years.
hung out till 2045.
It has to be presented as a normal, normal loan, normal debt service, but then as part of the New Markets tax credits, we only paid interest for 7 years, and then it got written off. So all of that's gone now.
You know, when I look at this as, say, a layperson,
Mhm.
how would I know that?
You wouldn't know that.
Yeah.
I mean, you could put a subsequent event disclosure in here if you wanted to. With the timing of it, with it happening in July, we're required to have this in here because as of June 30, that's the
Right.
requirement. You could certainly add a subsequent event saying that this was, and I thought we actually added something, but I could be wrong. That's as you were talking, I was trying to look through here. I thought we had added something about that, but we'll go back through here. We could add a couple of sentences saying that essentially this in July is,
It says it's C09.
yeah, and that's what I was thinking. Yes, here, this paragraph at the end of note 9 talks about in July 2022, the options described above were exercised. And those notes and interest were relieved. And there's the $4.5 million book loss that I mentioned.
So we end up with a book loss even though we got a loan forgiven.
You say it again?
We end up with a book loss even though we got a loan forgiven.
Yes.
Okay.
I think that's oftentimes how these work out, is you end up getting, because you're getting the money up front to, in this case, pay for the building, then you end up with a book loss later on in the process, just the way it works, because it's being all written off, but, yeah.
And this is usually a picture on June 30th. After that, everything's changed. June 30th picture.
Yes.
I fought really hard to get this all done before June 30th because of this reason, but we had about 25 people that had to get their schedules together, and July 14th was the soon as we could get.
Well, it'll be nice to see it going.
Mm-hmm.
Yeah, and so that, between that and the finding that we'll talk about, a lot of it is just really based on the cutoff.
Right.
And as of June 30, this is where transactions were, this is the balances that there were. And then after, if things happen afterwards, that falls into the next year. And so, like I said, we can put some subsequent dispersion or subsequent events in there, like we had a note 9, but it doesn't change the balance at that date. But I totally understand it. Sometimes it's confusing especially when you're looking at this 3 months after the end of the year and all these other things that happen, it's hard to kind of move back into that time frame. So skipping ahead, note 8 goes through the required pension plan disclosures, and all of this, as you mentioned, from GASB 68 a few years ago. It's added a lot of value to the readers. But here you can see really the breakdown of that net pension asset. And again, you can see the pension liability has been calculated as 16.3. You have 20 million in assets, and that's where you come up with the 3.7 pension asset. This table I always point out just because it really kind of shows the variability of the transaction and how much those actuarial calculations and estimates can change the balance. So this 1% decrease in the discount rate can decrease your pension asset more than in half, down to 1.7 million. On the flip side, if you have a 1% increase in your discount rate, it actually moves it up about 1.7 million. So that just kind of drives home that how variable that is, and that's really all out of your control.
And 6 is typical?
6 is pretty typical, yeah. Typically we see anywhere from 5 to 6.5% is kind of the range that we would normally expect, so 6 is right in that range.
I think the state always had some higher number.
Sometimes you'll see a higher number. In a few instances, you'll see a much lower number if there isn't enough funds. When they do the actuarial calculation, if they project out that you don't have enough funds to cover it, even with the investment returns, then you end up with a much lower rate, because then they have to use a risk-free rate, which is obviously much lower. And that actually makes their liability even worse. But for most plans similar to this, 6% is right in that range.
We're very happy that we're 100% funded.
Yes.
Okay.
More disclosures on retirement plans.
Let's go back to what Nikki just said. What do you see at other transit agencies?
All over the board. So it just depends on if they have their own plan and what they have historically done. So we have some who have their own plans. Typically the ones who have their own plans are in pretty good shape. I would say, I'm trying to think, I don't know that I have any other transit agencies I work with that have a pension asset that are technically overfunded. We have the ones that have their own plans are typically pretty well funded. The ones that are participating in a cost-sharing plan with the state or city or something like that, those are typically not well funded. So yeah, I would say you're in very good position. Note 9 goes through the new market tax credits. Again, that'll all go away. Well, I would guess we'll still have a footnote disclosure next year just to wrap it up, to explain what happened. It'll probably be much reduced. Note 10 is the required condensing information, which is very similar to the combining schedules that we have in the supplementary information. Again, that will go away in a couple of years. Page 34 jumps into the required supplementary information. This is all related to the pension plan. And this will obviously continue out. This is a 10-year schedule. Once it gets to 10 years, it'll just stay in a rotating 10 years. So again, nothing too significant to point out here. This is just breaking down the pension liability and the fiduciary net position. Same thing here, a 10-year schedule of the contributions. And so you can see you continue to make contributions in excess of the required amount, which helps with the funding and the asset position. And then this is also related to pension plan. This is your actual rate of return on the pension plan assets. So you can see last 3 years have had a good run of this. This is obviously based on the pension plan year. So when you see the December 31, 2021, that's based on the plan year, not the fiscal year of Lextran. As that would probably be a different rate of return if we were looking at June 30.
Definitely.
Page 37 gets into the supplementary information. This is again just the combining statements, so showing you the Lextran real properties and the foundation. We talked about how this will all roll up into Lextran next year. So again, we'll probably have these statements one more year just to show. This page will have likely nothing on it, but the changes in net position, this one will have some changes that closes out. On page 40, we get into the single audit portion of this, which is your uniform guidance federal audit. This is your schedule of expenditures of federal awards, your CFA, just listing out the federal grants that you expended during the year. So about 7.7 million. You see the COVID money up here, the 5.2, and then we had some other grants in here as well. All of these roll up into the federal transit cluster, which for most people that doesn't really matter. For us, that's what drives the testing. So those, when we're talking about the testing we perform, we perform testing over all of these grants, as we're required to look at those as if it's one program. So we subjected pretty much all of your grants to testing this year. So then from there, we get into the two reports that we issue related to that. The first is the independent auditor's report in accordance with government auditing standards. This is really looking at the financial statements and is less about the uniform guidance audit. So this is where we would report any findings about the financial statements, or in this case, the schedule of federal awards. So we do have the one finding that's listed here, 22-001. This, if we flip quickly to the back, is listed here, and this is what I alluded to earlier as from a timing standpoint. We did have an adjustment of about $4.1 million related to the preventive maintenance grant that wasn't actually executed as of June 30th. And so for a long time there was, I would say, some inconsistencies in how transit agencies especially would record these types of grants because they're a little bit unique in that they don't always get executed by the time of the end of the audit period, but they are for expenses that were incurred during that audit period. And there's also typically included in there what they call pre-award authority, meaning that they have approved that yes, you can spend dollars for this grant. But what happened was the GASB, the Government Accounting Standards Board, came out with a clarification that said that even though you have pre-award authority, if you don't have an actual executed agreement, you can't record that as a revenue and receivable. And so that's what happened here, is at the end of the year, June 30th, that grant for $4.1 million had not been executed yet. And so that had to be reversed off of the financial statements. So you're not losing $4.1 million, it's just not going to show up this year. It'll show up in the FY23 financial statements once the agreement is actually signed, which I don't know if it's been signed yet.
Very close.
Okay. So once that's signed, it'll show up in next year's. So it's really just a timing issue. But obviously the dollar amount is significant, and so that's why we are required to list this here as a significant deficiency. I don't view this as something as pervasive. You know, this isn't theft. It's not a reoccurring issue of bank reconciliations not being prepared or reviewed, or more significant issues. It's just, this is a one-time large grant that hadn't actually been executed. And again, previously, I'd say probably half of my clients were recording it as revenue if it was far enough along that there was a grant agreement that you could see that it just hasn't been executed, it's going to happen. So that's what happened there. Again, no major concerns, but it is reported as a finding. So
So what happens going forward on the timing? Will we always be crossing fiscal years?
No, we haven't had this issue very often, especially not with a 5307 grant, which is the normal formula funding. This one was delayed because we were waiting on the state match, because we received 2 years at once. So we had to wait on them to do the amendment, which they didn't do till about mid-June. And when a grant, even though you have formula funding, you have to fill out a grant application of many, many, many pages. And it has to go through about 2 to 3 months of approvals through FTA, so there was no time to get this one. The one for this fiscal year is already in the process, so it will be approved way before June 30th, so we shouldn't have this issue again, but
Okay,
it's
so
it's all about timing.
We will show a $4 million extra.
Mhm.
The thing I was thinking is if the timing stays the way it was, you show the $4 million, I don't want to say loss, but whatever you call it, from this year, last year. But moving forward, it would kind of balance each other,
Yeah.
even though you're behind, and so it's like you've never caught up.
Yeah, some transit agencies would have that issue depending on what they were waiting on. The state usually takes a little longer when they give money, but since we already have the match for 2 years, we went ahead and this one's pretty far along. It should be approved soon.
And correct me if I'm wrong, this is the particular match agreement that they amended twice.
Yes.
Correct? So
Yes.
that contributed to us
Yes.
not getting everything done in time as well.
It's not unusual.
Amended it to our benefit, so that
Yeah.
was good.
It's not unusual, that happens once,
Mhm.
even for IIs.
Yeah, definitely not unusual for transit agencies and not unusual for it to cross over years. It makes it a little bit more difficult to read the financial statements because, again, like you said, you have the expenses have already been incurred. So they're in these financial statements. The revenue that's going to reimburse that will be in the next one. And you're going to have now, it sounds like 2 years worth of revenue in next year's, which will make it look even potentially better from a financial standpoint. So it makes it a little bit difficult. There is no matching of revenue and expenses. And so that makes it complicated as well. But to your point, it's definitely not unusual. Many of our clients are dealing with this. And
It breaks all of your rules for accrual accounting.
yes. And trust me, we spent a lot of time. We actually contacted GASB directly about this. We talked to FTA about it as well to get their thoughts on it. But there is guidance on the pre-award authorities. You go back through the code, it actually specifically lays out that even though they're providing that authority to go ahead and spend, it does specifically lay out that they have no legal obligation to pay that. So in theory, they could just pull it back at some point. Now, obviously, if that happened, there would be a lot of outcry if they decided to pull the money back after you already spent it. But legally, that's what it says, and so that's where the GASB is residing. Is they're saying legally they have not obligated these dollars to you, and so that's where it falls. So.
All right, so it's not a reimbursement?
It is.
It is.
It is. We've already spent the $4 million. We're just waiting to get the
Well, I
money back.
understand that, but how are you able to get this year's already almost done? Can you say that?
The grant application, yes. But
Okay.
the grant application, the whole grant
Oh,
will
the
be
grant
approved, and I just draw it down based on,
Oh, got it.
yeah.
On
So,
your expenses.
yeah. So when the 2023 is approved, then I'll just draw down July, August, September.
Okay, got it.
So I'll go back a couple pages. So just to wrap up this one, as I said, the one finding listed here, but on the second page, as it relates to compliance matters, no issues of non-compliance to report. On pages 44 and 45 is the independent auditor's report required by the uniform guidance. So this is specifically looking at the federal transit cluster grants that we tested and providing opinions on compliance and controls related to the major federal program. So again, opinion listed here, so no compliance issues, no internal control issues related to the grants. And so while just to clarify, while the one finding that we were just talking about does relate to federal grants, it actually doesn't relate to any of the federal grants that are on the schedule of federal awards, because it obviously isn't a federal award yet. So it was just a financial statement finding. There was no issues with any of the dollars that were actually spent, and that were reimbursed with federal dollars. No concerns there. So. This is really just a summary of all of that. So you do see the one significant deficiency on the financial statement side listed here, but everything else is either no or none reported, and we are providing unmodified opinions for both reports. So any questions on the financial statements?
Good job.
Thank you.
Okay, so if no other questions there, I'll quickly go through the last two letters. The first letter here is what we refer to as the SAS 114, or the audit communications letter, because it communicates a lot of various information. And so just starting on page 1, it goes through again our responsibilities, both under generally accepted auditing standards and government auditing standards. Also discloses that we are independent from the authority, which this is actually new in the letter. If you were to compare letters, this is a new disclosure. Again, not new that we had to be independent, but it is a new disclosure in here. Goes through some of the planned scope and timing of the audit. Again, any new accounting policies would be listed here. We did list GASB 87 just because it's a more significant one, but did note that there was no impact. Some of the accounting estimates are included here. Nothing's really changed here. And really what we're looking for from our standpoint is just consistency and neutrality in those estimates, that you're not judgmentally moving those estimates around based off of to try to create different financial reporting results. That really ties into this section as well, as far as auditors' judgments about qualitative aspects. Again, if we felt like the management was modifying the financial statements in a certain way, or modifying the estimates to try to change the financial statements or the financial results, we would make you aware of that. We do have the one corrected misstatement that we talked about, the $4 million revenue and receivable. And then the last section of other communications is just a variety of information. So if we had any difficulties or disagreements with management, anything along those lines, we would make you aware of that, and we had none. So clean audit from that perspective. And then the last one-page letter here is what we refer to as the management letter. This is just where we disclose any material weaknesses or significant deficiencies, and we talked about the one significant deficiency. Nothing else to report here. So again, outside of that one kind of unusual transaction that was related to a clarification from GASB, no other deficiencies to communicate. So any questions on any of that?
Well, tonight you'll sleep like a baby. Well, every CFO is a nightmare. We want to give you some good news. So thank you so much.
Thank you.
Thank you, Brad.
Yeah, you're welcome.
Members of the Finance Committee, appreciate it. And
Steph?
As always, thank you very much to Nikki Falconberry and Stephanie Hoke. You guys do the lion's share of the work to get through this audit process, and it is much appreciated. So thank you.
Stephanie and I can attest that Crow did not leave any stone unturned.
No,
You all should feel very good about
Brad,
that.
did you have a whole new team, or was it just
We did not have a whole new team. We had Shelby Howell was the senior manager. She was on it previously, and I think the rest of the team was new.
Mm-hmm.
But so yeah, we had a good amount of carryover of knowledge. Shelby was helpful. Scott obviously is still around, so I could lean on him to ask some questions here and there. But we did make sure that we always try to take a fresh look each year. We typically will have some new staff members every year, sometimes out of necessity, sometimes just because we need to have some new people looking at the information. We don't want to have the same people looking every single year, because they may get kind of comfortable, and we don't want there to be that amount of comfort, so. That said, Nikki and Stephanie did a great job being prepared. And at the end of the day, a lot of the information we're asking for is the same information, right? We're not asking, there's nothing new to ask for. But we do like to have different perspectives and different eyes on it, just to keep a fresh perspective,
So,
thank you all.
Your fresh eyes on Lextran. Any comments? On the phone, you told me that you didn't know what to expect in our facility, and you were really impressed with that.
Yes,
And I said, and it's paid for.
yes, the facility is much nicer than I expected. As I mentioned, most of the transit agencies I work with don't have that nicer facility. A few do have nice ones, but it seems to be one end of the spectrum or the other, typically speaking. But I mean, honestly though, from a financial standpoint and internal controls, very pleased. I think, especially I work with smaller agencies all the way up to some of the largest agencies, and I think for your all size, the quality of people and controls that you have in place are good. That you're able to segregate the controls, the responsibilities. So no, I don't have any concerns. And like I said, even the one finding that we had, while it does fall under that significant deficiency category due to the dollar amount, I don't view that as a pervasive issue that, that there's some other underlying concerns to be concerned about.
Well, we always appreciate the work that Nikki and Stephanie do. And
Thank you.
I'm involved in an annual audit every year too.
Okay.
At UK, not the big UK one, but a smaller one. And I know how much work goes into that.
Yeah.
And all the questions that are asked and everything. So thank you again.
Thank you.
Appreciate it. And I think I told you on the phone that one thing about Nikki is usually when you ask her a question, she knows the answer. It's not like, oh, let me look it up. Although you had to look up
Except,
the
I know I-
CNG.
Leave her
And I don't know
alone.
and I don't know how many miles a tire
A
can
tire
get.
has-
Yeah.
No, you don't need that one.
I was throwing you softballs.
I know.
That means you'd be wading into the operations side, I think, if you knew the mileage right off the bat.
Yeah.
Yeah, we don't want that. No. Mm-mm.
I have one question, because I know last year we talked about just other trends that you were seeing in the industry,
Mhm.
and that's how the discussion started with our cash reserve policy out of the discussing about the audit last year. Any other trends or thoughts around what you're seeing in the industry?
No, I mean, the biggest things that are, I guess the hot topic things are just depending on where agencies are at with their COVID money, what the future looks like there, how far out they're projecting that to last or not last. And, again, a lot of it is around ridership and trying to get ridership back. For you all, ridership isn't as big of a piece, fare revenue isn't as big of a piece of the pie, so that's probably less of a concern to some degree. Microtransit continues to be a popular topic. We're seeing more and more who are either dabbling in that or going full bore into that. And again, that has been across the board from smaller agencies all the way up to some of the larger ones. So it really kind of, depending on the area and who you're trying to serve and what area you're serving, how many square miles you're trying to serve. There's a lot of different factors go into that, but that's another thing that a lot of places are talking about. So,
Brad, have any of your clients completely abolished fares on a permanent basis? Because that is something that we're seeing a lot in industry publications.
Sure.
Is that agencies are, dissolving fares.
none of mine have done that yet. I know Kansas City is, that's not one of our clients, but I know they have
Pretty
done that a couple of years, 3 years ago maybe. We work with Los Angeles. They have talked about it, but they're not, at this point, they're not going to do that. And that was with the prior CEO, so I'm not sure where that stands at this point. They had done a study on that at one point to look into that, but they have no plans at this point. And no, none of the others of my clients, I don't think any of them have any plans to do that anytime soon.
It's just interesting that what the things that we read, it's either,
Right.
it seems like the total opposite ends of the spectrum. They've gone fare free because they're doing so well, or they're approaching a fiscal cliff, that's, you know, they've been able to put off a bit because of the COVID relief dollars, so.
Yes. And that's, I mean, when you're talking about trends, it's difficult to come up with a trend across transit agencies because they're so unique, right? And so whether it's just the funding and how reliant they are on fares or not, or what their financial position is, I know some of the ones out east are in a little more dire position, at least based off of what you read and what their budgets are looking like for future years. Some of the others aren't as in a bad position. And I think a lot of the smaller and mid-size seem to be in a little bit better position, especially with the COVID dollars, because a lot of those weren't as reliant on fare revenue as some of the larger ones might have been. So.
You know, you're very fortunate. Your location and county/city is very helpful. My previous county, the cities were fighting, and then the tax base that you have, they don't have it.
Yeah, very true.
So that made it very difficult to rely solely on federal help and ridership. We're fortunate in Lexington, we have everything.
And one thing I've seen, Crow does quarterly, we did them monthly, I think, when COVID started. Roundtables where we'd have a Zoom meeting with all different transit agencies. And I was, realized at that point how thankful I was because of the property tax. Because a lot of them had sales tax or occupational taxes, and they were really struggling. So we were very, very lucky to have property tax.
And you have multiple cities fighting, they don't want to contribute.
Yeah.
Yes.
What,
I have a meeting.
what do they say in the trades about people that go to free fares, to ridership?
So,
Thank you.
there's
Thank you.
definitely some increase when they go to, fare-free system-wide, but I would say there aren't really good reports or good studies because so many have adopted it in the last 3 years. There's not really a good time period on which to evaluate, but lots do report an increase. Similarly, and we shared with members of the board during the time that we were fare-free throughout the pandemic, sometimes some of those ridership numbers that you're recording are people who don't have a true destination in mind, and are able to utilize the service in that way. Some of the larger systems who do have, what would currently be called fare enforcement, those folks kind of shift their responsibility, if you will, if they do go fare free to try to mitigate some of those things. But that's all stuff to consider, especially as there tends to be people who are out of work. So we will see what that looks like long term for those agencies.
Brad, what are you seeing on paratransit usage? Is there any trends there? Is everybody's increasing, decreasing?
That's a good question. I'm not sure. I haven't heard anything lately specifically on paratransit, so I don't know. That's a good question.
Because our cost is going to increase with our new contract.
Well, yes, I've heard that with many agencies that they're, at least the ones who have had to recently go out for a new contract, the costs have increased, which I think is pretty common. The costs have increased for pretty much everything, so that's not as surprising. But I haven't heard anything on ridership with paratransit specifically.
Do you have anything else? We appreciate you being here.
Yeah.
So I guess you'll come back to the board meeting.
Yes.
Do we have any old business to talk about?
We don't have anything prepared today.
We can stand adjourned. Thanks, everyone.
Do we go ahead and finalize these then? I guess just
Yes.
okay. So this approval today, we can finalize.
Yeah, because I need to send it to the city tomorrow.
Okay.
So I will Finance Committee report on the agenda and include the audit report early on. So you'll kind of tee it up like you did last year and then.
Okey doke. And you saw the
You kept